Well, good afternoon, everybody. Welcome to the Tuesday, September 6th edition of Bull Sessions. For those of us that stayed up late, I actually fell asleep watching the U.S. Open tennis matches last night. They actually went until 2:30 in the morning. And I don't stay up that late for many things these days. And the kid from Spain actually did win, so he's pressing on. Serena has basically reached evolution, but she had a heck of a run. My name is Mark Robertson. I am joined here by Kim Butcher. Good afternoon, Kim.
Hi, guys. How is everybody doing?
Did you find your chocolate, and is it sunny in Florida today?
It was 96 when we came in and from running some errands today, and it's dark chocolate, and yes, it's quite good.
All right, and we're also joined here by Sean. Speaking of chocolate, from Hershey, Pennsylvania. How are you doing, Sean?
Doing great. About to say we have all the chocolate out here, Kim.
Yeah, but usually it's all milk chocolate. I like dark chocolate.
Well, we also have Dove chocolate at the factory down Elizabethtown here, just 10 miles away from us.
That would work.
They take care of chocolate needs in Pennsylvania. Ken won't be joining us today. He is on the road. I kept trying to get him to swing by Punxsutawney, and he and Natalie were resisting, but they are on the road having some holiday fun these days. All right, so we're just going to basically kick around a few things here today. Still not happy with Jerome Powell. Sorry, Sean. But I have a new graphic thanks to you up there on the upper left.
You've been abusing that graphic for a while now.
But I don't think he's completely innocent in all the stuff that's going on. But it's definitely a team effort. So we'll basically discuss in the context of a longer term bear market when we get there. And then, of course, one of Sean's favorites, the advice when you reach the oracle to buy the dip. And I do think that still is good advice. I think that based on some of the stuff we're going to cover here today, I have kind of switched into a little more defensive mode. That does not mean accumulate cash and run for the hills. It means just ratchet up quality requirements on stocks that I study and accumulate. So I think we are kind of in that mode. We'll try to make a case for that. And that is generally a pretty good philosophy or procedure in any event. We're going to talk a little bit about Greenlight Capital and David Einhorn. That's the gentleman wearing the sunglasses at the World Series of Poker table there. He's a hedge fund manager that you guys are familiar with. He's also, as a celebrity groundhog, he's the guy in the pole position. So that'll be part of it. And again, the rabbit's just there to remind us that we are beginning our hunt for undiscovered small companies, promising companies that seem to be on an excellence track when it comes to management of the companies and the opportunities they pursue. So that is a work in progress. And then we are going to spend a little bit of time just reminding about the power of long-term trend analysis, a concept known by many of us as simply looking at the visual analysis on a stock selection guide and heeding the trends. And that's what we mean by antibody title analysis when we get to it. Anything you guys want to add to the general topics, the broader topics?
I'm looking forward to it. I think Hugh McManus also has a similar theory of buy the dip as well.
Oh, definitely. Yep.
I like Hugh's methodology of finding a 30-year low.
Yeah, he was kind of happy with my selection of 3M for the roundtable. He actually sent me a note afterwards saying, just reminding that he does, as he said during the session, run towards fire. And obviously 3M is going through some issues. People have sent me notes about the fairly large litigation issue they have with earplugs in the military. Are you up to speed on that at all, Sean?
Yes, I am. Yeah, I'm getting inundated with social media and emails on those earplugs. and it's brutal. They're getting anybody and everybody who's in the military.
Yeah, and so at last count, the amount of filings was up to 230,000. So it is an issue for 3M, but again, it's that notion of 3M's a pretty good company, and that's actually not that big of a piece, and they won't be paying it all no matter what the situation is. They have reserved $1 billion or $2 billion on the side to take care of at least part of the bill, but it's just a reminder that sometimes those opportunities are, as we were talking a few minutes ago, blood in the streets or blood in the gutters. Sometimes it's really hard to invest when times are rough or your companies are having a test of their mettle. So we'll see how that one goes. All right. Let's get the legal paperwork out of the way. No investment recommendation is intended. We will be talking about specific companies during this session, and when we do that, it is all part of an educational demonstration. We are basically referencing them for illustration of a methodology or a philosophy of investing where we literally attempt to discover the best companies and buy them only when they're on sale. So better companies at better prices is basically the name of the game. That's what we are demonstrating and illustrating here today. So what you hear are our opinions, our interpretations. Please do your own homework before making any decision about anything that we talk about. If we hold a company in our personal portfolios, we try to remember to disclose that. We're about 3 weeks out from the next roundtable, but if you'd like to be added to our email reminder list for that, please send an email to ncavula1@comcast.net. If you're not familiar with the roundtable, it is a monthly gathering where we basically do just that. We take 4 or 5 ideas and share the analysis of those ideas with the audience. That collection of companies has a tracking portfolio with a rate of return of, it's actually down to about 16%. It has been as high as 20%, and that's a 12-year track record since inception. So if you'd like copies of slides or if you have follow-up questions or suggestions for future topics, please send an email to markr@manifestinvesting.com. All right, this one's for you, Sean. Here's our normal slide that we put up more often than not, and not too long ago, that green price bar, which represents the value line arithmetic average, that's kind of an index based on all the companies covered by value line, had actually reached up to above the blue line. And then I went on vacation and everything kind of fell apart, but it was up in here. And while I was on vacation, we basically have sagged back thanks to the Jackson Hole. And what do you want to do to defend your future boss?
I just got to say, he's predicting 2 years out in the future, and it's difficult to do that with an economy. However, I will say he's going to bring in that he will bring the economy into not so good areas. But he'll put all the stocks that we want on sale here soon.
Okay.
and you'll like him for it then.
Well, he specifically said that he was going to cause pain. So
I think he was, no, he will cause a lot of pain, and it will be painful for a lot of people out there as the economy starts to tank. But even with the hint of hyperinflation versus recession, if you had a choice, they're going to choose recession every single time. And because it's easier to get out of recession than hyperinflation. So I don't blame him. I don't think it's going to be a soft landing. It's going to be a hard landing, but as long as we prepare for it, I think we'll do all right. Just find our companies on sale.
Well, that's
I really can't believe also on how, like, the price of oil, how much it's come down. Whoa.
Well, even that's changed recently. They're looking at expecting 10 to 20 cents additional at the pump as Saudi Arabia and then pull back as OPEC pulls back on production.
Well, I think I also saw where Russia is no longer going to give oil to Europe.
Yeah, and there's a whole lot of blocking mechanisms in place there also. It's a nasty situation. I think England, the United Kingdom, is actually getting a lot of the press for expecting energy bills to be as much as 10 times higher this winter. And that's pretty life affecting. And so that's just one example. Now, of course, the Fed doesn't keep track of food or drive vehicles, so kind of distorts all of that. But no, I mean, I get it, Sean. As I think I've made clear over the last few months, I just think they waited too long and they were
Agreed.
ignoring some pretty nasty signs. In fact, we have a slide here which shows that they may still be a little bit in ostrich mode. But I'm with you, Sean. I believe that opportunities are being created as hard as it can be. And you go back to 2008, if you want to talk 2008, 2009, so some very rewarding opportunities were created. And if you carefully search for them, back when you have this situation, here's another really nasty time in the stock market. Most people here in this gathering remember it. Yeah, if you find a good quality company on sale, you could be looking at a very rewarding long-term position or situation. And here's part of what I was talking about. This is something that you had mentioned to me last week or a couple weeks ago, Sean. And they do continue to basically do kind of expansionary things.
The biggest thing was they said that they were going to reduce their balance sheet.
Oh, did I drop out?
Say that again?
Did I drop out for a second?
Nope,
third?
you're good. I'm tracking here. They were supposed to start reducing their balance sheet, but they were reducing everything else and still adding to their MBS, their mortgage-backed securities. Literally, they started to finally reduce those. So no banks are buying back these mortgage-backed securities. They're just not doing it. Am I back on, Sean? I'm hearing you.
We never did not hear you, Mark.
Yeah.
Oh, okay.
I'm hoping people can hear me.
Apologize for technical difficulties. We literally have heavy construction equipment in our backyard, and it seems to be causing some disruptions. So you may have been able to hear me. I couldn't hear you, Sean. Did you have comments on this slide?
Yeah. So as I was saying, it literally just happened this week or last week where they finally started to reduce their mortgage-backed securities, even though the Fed has been saying they're trying to reduce this stuff, their balance sheet, and it just now is finally getting to it. But this was months ago, and it's taken them this long to finally get this stuff back. These banks are not buying these securities back, and it's because they know, I believe they believe something is going to happen here. So they don't want these bad stuff on their sheets, and they'd rather have the Fed have it.
Okay. Yeah, and this particular individual, Rudy Havenstein, he puts out a blog, and I occasionally will take a look at it. He's one of the more negative influences out there from a literary standpoint. All right, we'll press on. Here's one that I do think does have ramifications. I think many of you know that I get upset every time they talk about your 401ks on the nightly news. I really think that's a misrepresentation, and it's just not in anybody's best interest when the news anchors talk in the way that they do. But many of the 401k selections made by people are modeled around traditional asset allocation. A lot of the target date funds and all of that kind of stuff, they are modeled around this, and this is not a good picture for a lot of people with their 401ks, and in some cases many pensions. Pensions even overdo it more, and it's just a really nasty situation for people that are getting closer to retirement. So notice that they are going with hashtag Powell Pain, Sean.
I'm liking it.
Okay, but here's kind of a neat one, and we certainly have gone through this. Our home is approximately 40 years old, and we just did some fairly significant renovation. And when we talk about the residential housing construction and all of that fairly favorably. We're about to do a little bit more of that. There's also the renovation market, which continues to have really quite an opportunity push. And Sean, you're in the middle of a home renovation. Care to give us an update on how that's going?
Yeah, so things are going really well, nice and smooth here. We just got our deck finished up, and I know Lowe's is definitely profiting from us here. So between our deck and now we just got a new roof, and we're getting Tesla solar panels up. So, and then our house is 20 years old. So definitely the local Lowe's has been profiting from us quite handsomely.
Yeah, so we see the activity at Home Depot, Lowe's, and then we do have in the Tin Cup portfolio, we do have the building products firm. This bodes well for a lot of those. Kim did have to leave us, for anybody out there wondering. All right, so that's a good thing. And here, just to keep everybody grounded, we do like to pick up on these moments in time. I don't know if this came from Rudy or from somebody else on Twitter, but this is just to keep us grounded on anything that we read. This basically said that the 2008 thing, 2009 thing was not going to happen. And basically talking about a soft landing back then that didn't happen. So again, just a reminder about be careful about what you read and how you react to it. I do know that, I got up this morning to reading a number of very doomsday-ish type articles, and that's not good for anybody. And a lot of people are just guessing. It's the old clock. The clock is right twice a day if you predict calamity, and bedlam a couple times a day. Eventually, you're going to be right. Just be careful and try to keep it to kind of a fact-based situation, and try to spot opportunities that get created by this type of stuff. So
these echoes of the past, Mark, are just coming back to haunt us here. This is crazy stuff. If it really does, when you start to overlay 2008 and today on what's happening, when you overlay those two together, this is where it all started here. Oh, we avoided this catastrophe, so don't worry about it anymore. But
it just took for a while for it to ferment into place, I think, back then.
That's exactly it.
Yeah, and we're going through some pretty interesting challenges. I think that over the long term we'll be just fine, but we could have some nasty moments.
I think the common phrase back then was "Don't fight the Fed." After the crash happened, so I think here we can echo that too. Don't fight the Fed, because they're actively trying to push this down right now.
Yeah, so
trying to cool the markets down.
Again, I think back to the whole philosophy of sticking to the highest quality companies is probably in order, because they're going to get hurt the least and probably benefit the most when things shake out, if they do. And if they don't, it's a win in both directions, I think. So we'll see.
Absolutely.
And here is some of that type of stuff that you've done. And then this is just tip of the iceberg type stuff. This one is a first cousin to some of the charts you've been sending me, Sean. We basically have a situation where the price behavior is behaving in a way that hasn't been seen since 2008. Again, they're talking about general price behavior. And again, in the spirit of Ken Kavula, he tends to focus a lot on self-fulfilling prophecies. And there's some of that going on here too, just simply by virtue of algorithms. And any time that general prices in general dip below, as you can see here, as they break through and they dip below, they become self-fulfilling prophecies, because the rhino, the electronic robotic rhinos, kick into gear. And it's just again a self-fulfilling prophecy in many cases. So Sean says don't fight the Fed. Here's one of the reasons you probably don't want to do that. All right. And then here's an update on one of the charts that we do track that we do think has some capacity for gauging the general market environment. If you're new to this, you're basically looking at a chart where we take the new highs and subtract out the new lows. So anytime it is below zero, anytime that it is in this maroon type color versus the green up at the top of the chart, you have more companies setting new lows than new highs. And again, here's that infamous period back in 2008, 2009. And it was one of the worst periods in stock market performance. This is the S&P 500 that you can see in the area chart, and you can see the nastiness of the 2008, 2009 situation. By the way, the actual decline started on Halloween 2007 at the peak that you can see inside the circle. So we actually have reached a point here over the last year or so where, again, this sentiment indicator for the market is at best fairly unsettling. And this is one of the things which kind of drives me into that mode of, again, when people say run for the hills, my reaction isn't to accumulate cash and try to wait for those type of opportunities. I continue to invest regularly, but I will dial up, much as you've seen Cy Lynch do during the roundtables. I'll dial up quality. I will dial up financial strength on the companies that I screen for. And that's just basically the operating process for navigating this, because it will turn. It will turn at some point in the future that nobody can tell you when.
As long as you have faith that that there'll be an America tomorrow, it has to go back up. But I'm already interested in the fact that we're already at the low. It looks like our current low is just at the low of 2008.
Yeah.
So do we still have further to go with all the negativity going on, or are we going to go up from here?
You're talking about the moving average here.
Yes.
Yeah, we've actually reached that. If you had asked me to project a year ago, would we reach that level? I would have said probably not. So it's just simply a reality that we are back down at that low, which really, historically and foundationally, is a time to suggest buying and not selling. But shop carefully, shop very selectively, and I think you'll be pleased 5 years from now. All right. And then here again, just keeping things in perspective. Things happen. There have been really nasty things happen. Back the 1998 crisis of the Russian currency and the Mexican currency and the long-term capital management thing, that you can't even see that on this chart. In fact, I drew it in the wrong place. It's right here. And then the dot-com bubble at the end of the golden age from 1995 to 1999, which was just icing on the cake to something that started back in 1982, actually. But again, from left to right, there have been a number of challenges, but a pretty good long-term trend. So Sean, you sent this to me this weekend. What are your thoughts on seeing this?
I really just wanted to revisit the chasms and chaos bull session you guys had a few years back, because to me, you can just draw a bridge from the high of the .com bubble, draw a bridge, and a decade later, you're back to even again. And if you bought all the way down, and you still bought all the way up, instead of the decade it took to recoup everything, you would have recouped everything within 5 years. Same with the great financial crisis. It took another 6 or 8 years for the market to break even again. But if you bought all the way back down and all the way up, you would have recouped all that money within 4 to 5 years. I don't know how good your art skills are, but if you draw a nice little bridge from there, yeah, good bridge. You would have been able to get over that chasm pretty easily, as long as you kept buying on the way down. Those are the great times to make your money.
Yeah, and we've talked about this a number of times. I wrote the article to the open letter to the presidential candidates back in 2008, and it's been a favorite feature here at Manifest for a long time. That's exactly the story as Sean just stated it. I think our recovery, where we got back to where we were, it was literally a couple years ahead of the market, and certainly a couple years ahead of here. And so just continuing to invest, to stay invested, gritting our teeth as we went through this moment in time. I'll make this a smiley face. Through this moment in time, it just was quite rewarding. And I can remember sitting up over adult beverages with a couple of the SEC officials at one of our national conventions, just talking about that moment. And, you know, how frightened the average investor was back in that time frame. And I think we've talked about that here, the discussions that we had about how, you know, our community of investors is different. We are able to grit our teeth, pretend we're smiling, but find an opportunity to invest in. And don't want to brag, but our Delix is up to almost $1.20 today, Sean.
Take the wins.
Yeah, hopefully that will continue in the right direction. So you do that right, you do it consistently enough, you can actually get to a point where you don't feel that bear market or that recession quite as badly as again the average investor. And then of course the nightmarish scenario, which we've also talked about here before, was the group of teachers that I met with, and they all basically went to cash in their 403Bs at just the wrong time back in 2008. And I went back to visit them a few years later, and most of them were still in cash. That can do a lot of long-term damage to, you know, the opportunities that could be provided by a retirement fund. So we would like to see those situations avoided.
Absolutely. And I think there was a recent article that came out that you only make the gains are only made within like several days throughout the year. There's several days in a year that you will see your largest gains occur. And if you miss out on those, you miss out on the year.
Yeah, and that's one of the fallacies of market timing. So we basically say,
that's how you stay in.
Why point that gun at your head? There's no sense. All right, let's go ahead and move on to current situations. Our groundhogs are continuing to get slaughtered in this nasty market. David Einhorn, our celebrity groundhog leader at Greenlight Capital, is the only person north of $1 million now. I think there were 3 or 4 last week. In fact, you were above $1 million not too long ago, Sean.
I was.
And you're paying the price for this downdraft in the market.
Yep. Yearly.
But
that's right. So is everybody else, though. I got how many other people below me? So I'll take that.
Yeah, and I was up 17 positions last week, and I'm down 8 positions this week. So I have a bit of volatility going on there. Again, the average results, negative 7%. We are encouraged to see some of these hang in there pretty good. Herb Lemcool continues to be a threat. And Kurt, with his 5-minute stock selection procedure, is up near the top. So is the monkey from Graham Stephan. But again, as a reminder, the Wilshire 5000 is what we use as the stock market benchmark. $1 million invested in the Wilshire 5000, the ETF that we use, is the Vanguard Total Market Index. That is worth approximately $861,000, and that's since just February. So if you're above that, you're beating. If you're below that, you're not. We usually see anywhere from 60 to 80% of the participants in this contest beat the Wilshire 5000. So this number is really unusual. So it's an unusual market for our community. There's not a whole lot of fence busting going on in this contest. I mean, people are picking the type of stocks that they would most often invest in. Those that didn't do that are at the other end of the list for the most part. But some interesting behavior here. So let's talk a little bit about the celebrity. Last week we talked about and reminded that Kathy Wood, although she's been in a terrible slump for the last year and a half, her longer term returns are still pretty good. And that's also true with or the opposite is true here. Einhorn's Greenlight was up almost 6% in August, and he has a really spotty track record in the Groundhog. In fact, his average return for the Groundhog going back the last 10 years or so is closer to minus 10%. But you can see if you go all the way back to 1996, he's got a pretty decent annualized total return also. He's also infamous, and you'll like this, Sean, for being one of the investment professionals who went against the Lehman Brothers situation. And while your best buddy, Jim Cramer, was touting the virtues of Bear Stearns and Lehman Brothers on TV, David was betting on the other side of that situation.
He was betting into the mutual fund, the Inverse Kramer Fund.
The Inverse Kramer Fund was working out pretty well for Einhorn back in those days. So let me go ahead and blow up the current holdings. This is what he's actually riding to a lead right now. And this is a community favorite since Matt Spielman has brought it to us. This is a residential construction company out of Texas, and David Einhorn is the chairman of that company, along with Greenlight Capital. And you can see that it does represent nearly a quarter, a little more than a quarter of their overall hedge fund portfolio. So Green Brick has actually been doing fairly well. It's one of our best small companies. So we'll see that in a minute. But Einhorn has been involved with Green Brick all along the way, and it's a pretty good story. It's a good study. If you're not familiar with Green Brick Partners, Matt Spielman keeps us pretty much up to date on the forum, and it's got some interesting looking virtues. Brighthouse is also, that's an insurance company. It's a turnaround distressed merchandise play. I don't remember if I put together a picture on that one or not, but it was pretty brutal. Taking advantage of the return to travel. Atlas Air, it's basically airport services. It's part of what they do. And so you get a feel for the type of companies. There's going to be a number of, again, distressed merchandise type stuff. He's a little bit hedged with gold that you see here, something that we typically would not do. And this is actually silver. So he does have some precious metals exposure. He's basically protecting himself a little bit. That has not always proved to be rewarding, but just more evidence of a challenging market going on.
I think gold is actually down year to date right now.
Mm-hmm.
Michael Campbell points out that he remembers Kramer saying not to worry about Bear Stearns. I think a direct quote would be along the lines of, everything is fine with Bear Stearns. It's a good buying opportunity now, just before it fell like some 90%.
Yeah, and that was within a few days.
Yeah.
Of him making that statement. Yeah, I remember it well. All right, so that's the type of companies that he's invested in. One that kind of caught my attention. Anytime I look at something like this, my attention is drawn to tickers that I'm not familiar with. And here's one here, this Kyndryl Holdings we'll talk about. And there's a couple others there, but can be an opportunity to dig into stuff. Now, keep in mind that he's not a traditional core investor, very much a special situations hound. And that's what you basically see. Here's a look at Green Brick Partners, though. This is that position at the top of the hedge fund. Again, a Matt Spielman favorite. Nothing wrong with this company. Again, the long-term look for residential construction is good. It's going to have its valleys. But Einhorn would echo much of what we've talked about here over the last 6 or 7 months, that even though we're going to see some softness and weakness based on economic conditions and the stuff that Jay Powell's doing to us, the long-term picture for these companies is actually quite promising. Undersupply and just a real need for effective housing. Does that mean prices aren't going to fluctuate? Of course not.
Cynthia is asking about, are you aware of any reason why Green Brick is prices dropped from $30 on August 8th down to $23 recently? other than the downturn on the market.
Yeah, I think that it all combines. I think that the downturn in the market, I think that the press on the general story out in the press is that housing is getting crushed again. Yeah, it's going through one of those economic cycles, some of it self-imposed by some of the monetary policy going on. And higher interest rates, people have a problem with that. If you really take a look at some of the pedigree companies that are in home residential construction, you find that they actually have done quite well through inflationary periods historically. And that is the expectation that Einhorn would have for Green Brick Partners, that even if the inflationary environment persists, these guys will actually do okay, and probably better than average.
The thing that makes a great company semi do really well during inflationary periods is how much they are able to divert any of their costs to the consumer during those inflationary times. And residential builders are able to do that because when you're buying a house, you're expecting prices to be higher than normal. So they're able to transfer over that inflationary pressure onto the consumer, and that helps them out too.
Yeah, and one of the things that Matt points out is these guys do maintain a very progressive inventory of new lots and places to build, whereas many other builders will actually be faced with those inflationary increases in those, which become a cost instead of an appreciating asset. So, interesting strategy, and these guys have a pretty good track record. Here's that other company. The ticker was KD. It's not a company that I had ever heard of before. Trust me, this is probably the largest company that you haven't heard of. Well, a few of you probably have, but this is actually a spinoff from IBM, a fairly recent spinoff of much of their IT department. Is this somebody that you have worked with in any capacity, Sean?
No, I'm not. This is the first time I'm hearing about them.
They are headquartered with IBM out of New York, but much of their workforce is in the technology triangle down in North Carolina. So I'd never heard of this before. They are basically management consultants in the spirit of an Accenture or a company along those lines. And this is the company as mentioned on Insider Monkey, Monkey, in the Greenlight description of the company. And again, it's a fairly large enterprise out there that's always been a part of IBM. We'll look at the visual analysis here in a minute. But again, a typical technology services company with providing IT to a whole bunch of people. And they are leveraged pretty well with some pretty powerful players in Oracle and Cisco. And their list of companies, as you read through their management discussion and analysis, is pretty impressive. And again, one of the largest companies that you probably have not heard of. Here's a look at the visual.
Like a company like how Taiwan semiconductors are to Samsung and Apple. So they provide services to the big guys and not necessarily to the end users.
Mm-hmm. Yeah, so these guys have a very, very robust and diverse set of customers. This is much of it is pro forma data. They have basically spun off fairly recently. You can see that they do not have earnings. So this is, again, filling the bill of a special situation for Greenlight Capital and David Einhorn. But they basically are gearing up for a fairly decent looking picture going forward. The only numbers you can really sink your teeth into are the sales, which they are projected to have, and their earnings before taxes, depreciation, and amortization. The operating margin is a fairly good looking situation. It's easy to see why Einhorn is interested in the company with that type of a return, trading at a very low position in the price range. So the opportunity could be there. You can see that Morningstar is looking at this $10 company with a potential fair value of closer to 23. So again, a special situation, probably not one that I would pursue under current day conditions unless it really took a I'm not even going to say that. I probably would wait to see a little bit of operating results that you can sink your teeth into. But it would be on the radar screen along with Globant and some of the others that we've talked about over the years. So watch for them in your IT adventures, Sean.
Oh yeah, no, I will be keeping a close eye on them.
Okay. Here's a quick update on the best small companies as far as how things are going. As I mentioned, Green Brick Partners is among our top performing companies. One of the few that, relative few, that are beating the market and actually holding up fairly well. I mean, the fact that it's dropped back from 30-ish to the low 20s doesn't cause a whole lot of heartburn for me, although we'll take all the help we can get between now and Halloween. The current status is that our traditional buy and hold portfolio does trail. This is the active portfolio, as is shown here, with some actual replacements. Doing a little bit better. We had almost caught up to the market, which is, again, this is $2,000 invested back on Halloween of last year. So everything is down. The general stock market is down less than either of our small company portfolios, but they are all significantly continue to be ahead of the Russell 2000, which had come within an inch of crawling above that dotted line before what has happened here in the last month or so. Nasty stuff. But from top to bottom, there are some interesting opportunities. I do think that there probably are some interesting opportunities in the bottom half of that chart that have been punished a little bit more than they probably deserve over the long term. All right. So with that, let's close with a quick look at, this is a session that we put together at a very key time. This is right after the effects of the pandemic started to land. And we wanted to talk about, as the environment impacted so many of our companies with chasms, declines in fundamentals, how to look at them over the long term. And the thing we want to spend a little time with here today is the opposite side of that. But here's kind of the situation. Ulta Beauty is a fairly widely held company in our Manifest 40. And as the pandemic hit hard in early 2020, you can see that the swoon in the stock price was fairly significant. And their operating results were obviously also impacted by that situation. And the message that we went out with during this presentation, and it was kind of a similar feeling to what we were talking about a few minutes ago with there's so much bad news out there and and ominous forecasts that there's kind of a similar feeling right now to this one. I can remember when Cy Lynch picked Five Below for the roundtable back in this time frame, and somebody pointed out that most of their stores are closed for the pandemic. Is yeah, but that's temporary. They'll be back open someday, and things will be fine. And it's actually turned out to be one of the best performing stocks. So again, the thought process being, what do they look like coming out the other side of the chasm? Here was the entire group of companies as characterized by the arithmetic average, and you can see fairly nasty price drop back in March going into April of 2020. So these are two slides that actually from that program. What we want to talk about for just a few minutes is the other side of that picture. And kind of tough to make out there, but the surfer below that fairly significant wave. And that's kind of what we're going through. We've talked about the waves in the swimming pool and that kind of stuff here over the last few months. And we are kind of at that point. And I think Regeneron, a company that we've talked about quite a bit, it's a multi-time selection for the roundtable, is an example of the other side, the opposite of a chasm would be the benefit. This is a company that actually benefited from providing vaccine related stuff, testing related stuff, and the antibody remedy for people suffering from COVID-19. And all of that added up to what you see here, this bubble or bump up in sales, along with an accompanying uptick in profitability. You can see that here and here. And then that, of course, actually causes an artificially low PE ratio because the E shot up in the PE equation. So as you look at this type of a situation, this is one where could it be a one-time thing? I think in the case of Regeneron, it could be. So you're really kind of faced with, well, what does the company go back to? And they actually have a handful of established products that it's basically a return back to this trend line. But you're basically looking at a situation where their 3 to 5 year sales forecast is less than the 2021 result. So again, our message would be pay attention to the trend line, maybe treat 2021 as an outlier as you do your analysis. Certainly, if not an outlier, certainly de-emphasize the fact that it's really kicking things up there and pay a lot more attention to the longer term trend. And
I 100% agree with you on that, Mark. For a lot of my analysis of companies, I tend to ignore the 2020 and 2021 years because it was a crazy time. I mean, it's not exactly something that happens every day where you have those a pandemic and we're trying to work through it. So I tend to dismiss those years for earnings for that stuff.
Yeah, so it's a matter of just de-emphasizing something which you know is probably not going to persist. Who knows? I mean, we could see some type of an uptick or whatever in the stuff that Regeneron does, but this is just a fairly decent reminder of it really is that longer term trend line that matters, at least from our perspective. Here's one that's probably not quite the same story, and I don't know what to expect going forward from Moderna, but they were basically tracking along at very low sales, and this is what the pandemic did for them. And this is actually a little bit dated slide. I think the expectations for revenues are probably now back down around here. So again, study your companies, study the field of opportunity, because this is kind of the expectation, the work in progress as you study the company. Now, if you do study everything and you decide that Moderna's got other solutions which will, make their way through the pipeline and fill in what seems to be missing here, could be a whole different story. But I think this is the type of company which really challenges Value Line and Morningstar in many of us to come up with. So again, you got to look for that, how much of it is one-time opportunity and how much of it will persist. And I can remember years ago being involved in a fairly detailed discussion about the dangers of single product companies. And that's what this kind of brought to mind for me. If you're dealing with a company, could be even a drug company, if they have a single product, what happens when the patents run out? What happens when competition decides to come in? And for a single product company, it can be quite a nightmare. Any other thoughts on that, Sean?
No, not when it comes to Moderna. I just keep going back to my Tesla stuff. So.
Okay. All right, here's your reminder that we archive all of these presentations on YouTube under Manifest Investing. And we'd greatly appreciate it if you'd subscribe to be notified anytime we add new content. We do put the bull sessions, the roundtables, and any other snippets of educational materials. You can see that Sean has contributed an analysis of Target, and I think he's working on a Costco entry that he may share with us here in the not too distant future.
Yep, that's correct.
Okay. So again, go there, subscribe, and we'll let you know anytime something is added. And with that, I thought in celebration of tomorrow's GameStop earnings coming out, do you have any words of wisdom for us? And are you
Do you want to subjugate your audience to this?
well,
I'm just looking forward to them.
How many people do you know have shown up for congressional testimony and started off their prepared remarks with, "I am not a cat"?
He's a legend in everything he does. He's hysterical. And we haven't heard from him since then. That was the last time we heard from him. He's been off his Twitter page and all that. So, but you know, Reddit definitely keeps him keeps a shrine of him somewhere.
And what's a socially acceptable nickname for him?
He goes by Roaring Kitty. We'll keep it PG for that.
The Roaring Kitty. So that's the PG version of some of the nicknames that he's got. But you know, I think maybe at some point, I don't know how much we actually covered this. I want to go back and look and see if we did actually give this any detailed coverage, because the GameStop story now in the rearview mirror is really quite fascinating. And when you really take it back and you look at his name is Keith. Am I correct in that?
Yes, Keith Gill.
Okay, so Keith actually put together a very compelling analysis of the opportunity at GameStop and an analysis of the short selling madness that was going on and the transformative nature that the company was potentially going to go through. And he basically laid all this out on the Reddit platform, and it really was quite thorough and ended up being pretty cool. Now, he personally owns, I don't know how many shares, Sean, but it's a huge block of shares.
It was because he put all his money into options, and once GameStop took off, he was able to sell those, and he doubled down again to buy more stock of it. It was just an amazing feat to see just this normal guy that just kind of came out of nowhere and was able to see everything that was occurring. And he was correct. If you go back to any of his YouTube videos, he just is able to just foresee exactly how GameStop was happening. And he took a company and said they're going to be debt free here soon, and that's exactly what GameStop did. Now they're $0 in debt with actually over $1 billion in cash, you know, and he was able to see what they could become, and they've been amazing, creating an NFT platform, and they're taking on large other cryptocurrency and NFT platforms such as OpenSea, which I believe is valued at over $13 billion. So, I mean, GameStop is seeing the future in a lot of this stuff, and Keith Gill was able to predict it all. It was definitely an amazing feat to see that.
Well, I want to thank you for taking me along on this ride, because I tuned in on it just in time to catch that run up. And, you know, to our community of investors, we are definitely buy and hold for as long as it makes sense to do so. And we are committed to that. But the people involved, the Reddit stock crowd, they are ferocious buy and hold in a case like this. And I mean, let me just give you an example. I mean, this company started down around $4, and by the time I became interested, it was in the $10 range. So one day we're sitting there watching it. It went from 10 to 40, and I actually took a position in a few shares. And over the period of the next couple of hours, it went to 80. And Sean and I were communicating through this entire ride. And, you know, when a stock goes from $10 to 80, it's pretty hard to hang on to for those of us that, you know, watch the stock market. But people like Keith, they continue to hang on to it. So I sold mine at, you know, at a very nice gain, at least I thought. And then for the rest of the day, it proceeded to go from 80 to 200. And at one point, I think it reached 400 something.
Oh yeah, the peak price was $425 at some point. And it's been a crazy ride, and that's when shorts were starting to cover some of their stuff, but their prevailing theory is now shorts haven't covered all of it. So that's why they're still up as high as I think they're $25 right now. They just did a recent split. But the big game changer here was Ryan Cohen. And for those who don't know who Ryan Cohen is, he's the guy that basically started Chewy, the former CEO of Chewy, who was able to take on Amazon and create a $1 billion company that I think Petco eventually bought. So you had a guy that started from nothing, was able to take on Amazon. Now he's in charge of, he's a chairman of GameStop, and he has zero debt with $1 billion in the bank account. So, well, let's see what he's going to be able to do with that now. That's the big thing. And that's why GameStop is still holding it, hanging on in there. And they have their earnings tomorrow. Everyone's looking forward to it.
So I do have a couple of play shares in my trading account, or my special situations account, if you want to call it that. So let's hope they report some decent progress, some operating promise here over the next couple of days. Anyway, it's a fascinating story.
Gill, somebody was asking that here.
Excuse me?
His last name, Marcia was looking to see what his last name was, and it's Keith Gill, Gill.
Yeah, he did a nice job calling it. And again, not just him, but the crowd, the Reddit crowd that buys this company. And who can hang on to a stock that goes up to 450 and then drops back down to 80? I mean, and they just buy more.
That's exactly it. It's crazy the following that it has. And to top it all off, they're officially registering all of their stocks, all of GameStop stocks, with the direct registering company,
right?
To get them out of the market. And it's crazy the following that this has.
Interesting stuff. So maybe someday we will go back and relive those moments and share any lessons that we can learn. But the meme stock stuff is still out there in force, so keep that in mind. All right, so with that, we're coming up on an hour. Any closing comments, Sean?
Ann Manning did have something to say. She wanted to speak. If she's still available there, I'll unmute you here, Ann, and you just have to unmute yourself, but go ahead and say what you wanted to say.
I should be unmuted.
Yep.
Okay. Yeah, back in the beginning of the session, and you were showing all the charts, it made me think of something I'm seeing on stock charts, and I wanted to see what your thoughts were on this.
Okay.
A lot of the companies, obviously, a few months ago went through the death cross, and their 50-day line just kept going down and down.
Mm-hmm.
And I've noticed in the last week or so that a lot of the 50-day lines are going back up. Even though their price is down, the line is going back up, and it's headed towards going over the 200-day line. So you want to give me some thoughts on what's happening?
Do you have a company in mind, Ann, or?
Well, Qualcomm is one.
Okay.
I mean, it went down, and then actually it started going back up in July, and it's continued to go back up even though the price is down. So I don't know what to take from that.
So your question revolves around when Ann is referring to the death cross, that's where the shorter term moving average for Qualcomm, and bear with us, we're not chartists or technicians here, but we do happen to keep track of a couple of key technical characteristics for many companies, and this one is referred to as the death cross, when the shorter term moving average actually crosses and goes through the longer term moving average, which in this case is 200 days. So this is generally a bad sign for many companies, and again, some of that self-fulfilling prophecy is seen here, in our opinion. And so your question has been that some of these companies have actually come back, and have they actually?
I mean, they're headed towards the 200-day line, but yet their price is still down.
Yeah, and the technicians, the rhinos and the algorithms, this becomes to them kind of a resistance position. So when this price came up here and hit this moving average, it becomes it encounters what they refer to as resistance, and this is basically a reflection off of that. in their
So
world.
they're saying it's resisting going up.
Yeah, and it will continue to meet that type of resistance. And again, that is all price and volume for those who trade in stocks and not invest in them. That's what's actually happening. So we just like to understand this if we're in our club meetings and can explain, that type of behavior. If it actually goes through, let's say that they do have positive price action in going forward from here, and the red shorter term average actually catches up or approaches the blue line, you can actually get to where it flops around. And if the price gets greater than this long-term average, it can actually become support. It flips to support. And that's the way they think of it. And you can actually get some fairly significant positive price momentum from that. So it's just, this is just in the case of Qualcomm right now, that $150 price level it's real from an algorithm standpoint. I don't know if that answers your question or not.
No, it does. It does. I didn't understand because I keep seeing this, that, all of a sudden that line is going up, but yet the price is still down. So I didn't understand why that was happening, but that makes sense that they're, it's kind of controlling it at the top.
Yeah.
Well, okay.
This red line began to go up just on this strength of price activity. Again, keep in mind it's a 50-day trailing average. So when you get a price that's actually increasing, eventually it's going to tug that up as an average.
Okay.
It's a trailing average. So.
Okay. Okay. Got it. Okay. Thanks.
Okay. You're welcome. Anything else in the hopper, Sean? Did we lose Sean?
Nope, I'm good. Sorry, that was my fault.
Nope, not a problem.
Shirley is asking if we can show the Regeneron chart again, please.
Okay.
You have a specific question on that, Shirley, or just wanted to take a quick look at it? That nice little bump that many companies had, including Boston Beers.
Mm-hmm. Yeah, so there's the chart. Again, this is a fairly well-established company. It's been selected a number of times for the roundtable. So you can actually, let's do a quick demonstration on that.
Yeah, Shirley just said she wanted to see it real quick, so.
Okay, we'll take a quick look. If you go to YouTube, let's see here. If you go to the channel, and like I said, it's been a multi-time selection for the roundtable. You see that we're up to 916 subscribers. There we go. And you can just go ahead and enter the ticker or the company name. I may not be searching in the right place. Let me look here real quick. It's as good as any. And you can actually find, well, this is going to give us all articles on Regeneron. Let me go back here and go into our page. I thought there was a search function right here.
There it is.
It is. So if you search, let's do the ticker.
REGN.
Now you're searching just on that page. Here's a short that Sean put together, which gives an update on the company. And it was mentioned during this roundtable. It was mentioned during this presentation, expected returns. And then here's another one. So if you want to go back and actually listen to some of the analysis of the management discussion and some of the product profiles and that type of thing, you can do that on almost any company. Costco could be another example. So if you're on this page and you're looking for just the times it's been mentioned during roundtables, and of course we talked about the long-term performance of Costco, a single-time selection nearly 10 years ago in the roundtable there, you can find that situation. Here's another mention of it back during one of our midweek discussions. So again, if you go to YouTube, search for Manifest Investing, you will find this page. And surely that's where you can go to if you want to dig in and see what we had to say about the company when we selected it. We selected, featured Regeneron during roundtables at the National Convention and then in the follow-up sessions after that. All right. Anything else, Sean?
Nope, that clears the questions out there. So Leo Douglas wants us to let us know that QCOM has over 130,000 patents.
Who has that? Who has over 200?
130,000. Qualcomm.
Oh yeah, yeah. Qualcomm. In fact, Len Douglas is in the middle of exploring some of the increase in debt and what they spent it on. There was an acquisition involved in there. So if you want more on what's been going on with some of the balance sheet at Qualcomm, go to the Manifest Investing Forum and check out the exchange between Ann and Len Douglas on Qualcomm. All right. So with that, I guess we'll say everybody have a great week and get out there and enjoy what is left of our trailing off summer. Thanks, Sean, for helping out today.
Thank you.
And we'll be in touch soon.
Got it. Take care, guys.
All right. Take care, everybody.